Interest rates are among the most influential variables in modern financial markets because they affect investment decisions, corporate financing, asset valuation, exchange rates, and overall economic activity. Within the CPA Australia Financial Risk Management (FRM) framework, understanding interest rate behavior is fundamental to managing liquidity risk, funding risk, investment risk, and capital structure decisions. Changes in interest rates influence borrowing costs, bond prices, equity valuations, cash flow projections, and the cost of capital, making interest rate management a critical responsibility for Treasury professionals and management accountants. As organizations increasingly operate in volatile global financial markets, the ability to interpret interest rate movements and their underlying economic drivers has become essential for strategic financial planning and effective risk management. Why interest rates are important. Interest rates represent the price of borrowing money and the return earned by lenders for postponing current consumption and accepting credit risk. They perform a fundamental economic function by allocating capital between savers and borrowers while influencing consumption, investment, production, and economic growth. For businesses, interest rates directly affect financing costs, debt servicing obligations, project evaluation, and corporate profitability. An increase in interest rates raises borrowing costs for new and existing variable rate debt, potentially reducing investment activity and profitability. Conversely, declining interest rates reduce financing costs and encourage capital investment and business expansion. Interest rates also influence asset prices across financial markets. Bond prices move inversely to interest rates, while equity valuations are affected through changes in discount rates used to value future cash flows. Property markets, exchange rates, and consumer spending patterns are similarly influenced by changes in interest rate expectations. For management accountants and treasury managers, understanding interest rate behavior supports funding decisions, capital budgeting, liquidity management, and financial risk mitigation strategies that preserve shareholder value. Drivers of interest rates. Interest rates are determined by the interaction of macroeconomic conditions, monetary policy, market expectations, and financial market supply and demand. Several key factors influence interest rate movements. Monetary policy. Central banks play a dominant role in determining short-term interest rates through monetary policy. By adjusting official policy rates, central banks influence commercial lending rates, deposit rates, inflation expectations, and overall economic activity. Expansionary monetary policy typically lowers interest rates to stimulate borrowing, investment, and economic growth during periods of weak economic performance. Conversely, contractionary monetary policy raises interest rates to control inflation and moderate excessive economic expansion. Central bank policy decisions therefore have widespread implications for corporate financing, treasury management, and investment planning. Inflation expectations. Inflation is one of the most significant determinants of nominal interest rates. Investors require compensation for the expected decline in purchasing power resulting from inflation, leading to higher nominal interest rates when inflation expectations increase. When inflation is expected to remain low and stable, borrowing costs generally decline, encouraging investment and consumption. Conversely, rising inflation expectations typically increase interest rates and financing costs while reducing bond prices and affecting corporate investment decisions. Management accountants therefore incorporate inflation expectations into financial forecasting, investment appraisal, and treasury planning. Economic growth and business conditions. Strong economic growth increases demand for capital as businesses expand production and consumers increase spending. Greater borrowing demand may place upward pressure on interest rates, particularly when capital supply remains relatively fixed. During economic downturns, reduced investment activity and weaker borrowing demand frequently contribute to lower interest rates as policymakers seek to stimulate economic recovery through accommodative monetary policy. Business cycles therefore influence both short-term interest rates and longer-term capital market conditions. Government borrowing and fiscal policy. Government fiscal policy also affects interest rates through public borrowing requirements. Large government deficits financed through debt issuance may increase demand for capital and place upward pressure on market interest rates by competing with private sector borrowers. Conversely, reduced public borrowing may increase capital availability for private investment and contribute to lower interest rates. Treasury managers monitor fiscal developments because government financing activity may significantly influence long-term funding costs and capital market conditions. Global financial markets. Modern financial markets are highly integrated internationally, allowing capital to move rapidly across national borders. International interest rate differentials, foreign investment flows, exchange rate expectations, geopolitical developments, and global monetary conditions all influence domestic interest rates. Consequently, multinational organizations must consider both domestic and international factors when managing interest rate exposures and financing strategies. Nominal and real interest rates. An important distinction in financial analysis is the difference between nominal interest rates and real interest rates. The nominal interest rate is the observable market interest rate that includes compensation for expected inflation. It represents the contractual borrowing or investment return quoted in financial markets. The real interest rate measures the increase in purchasing power after adjusting for inflation and reflects the true economic return to investors or the real cost of borrowing for businesses. The relationship between the two may be expressed conceptually as nominal interest rate is almost equal to real interest rate plus expected inflation. Understanding this distinction is essential because investment appraisal, capital budgeting, and long-term financial planning often require differentiation between nominal and real cash flows and corresponding discount rates. Using inconsistent combinations of nominal and real rates may produce misleading investment valuations and suboptimal financial decisions. Pre-tax and post-tax interest rates. Financial analysis also distinguishes between pre-tax and post-tax interest rates because taxation significantly influences financing costs and investment returns. Borrowers often benefit from tax deductibility of interest expenses, reducing the effective cost of debt financing. The post-tax borrowing cost may therefore be substantially lower than the nominal contractual interest rate. Similarly, investors evaluate after-tax returns when comparing investment opportunities, incorporating applicable income taxes, capital gains taxes, and other tax considerations into expected returns. Management accountants incorporate tax-adjusted interest rates into investment appraisal, capital structure decisions, and treasury management to ensure accurate financial evaluation. Yield curve and the term structure of interest rates. The yield curve illustrates the relationship between interest rates and the maturity of debt securities issued by borrowers with similar credit quality, most commonly government bonds. The yield curve provides valuable information regarding market expectations about future economic conditions, inflation, and monetary policy. A normal upward-sloping yield curve indicates that longer-term interest rates exceed short-term rates, reflecting inflation expectations and compensation for longer investment horizons. An inverted yield curve, where short-term rates exceed long-term rates, often signals expectations of economic slowdown or recession and has historically preceded periods of economic contraction. A flat yield curve suggests uncertainty regarding future economic conditions and often occurs during transitions between economic cycles. The broader term structure of interest rates explains differences in yields across maturities through factors including inflation expectations, liquidity preferences, maturity risk premiums, and market segmentation. Treasury professionals utilize yield curve analysis when evaluating borrowing strategies, debt maturity structures, bond portfolio management, and interest rate hedging decisions. Overall, understanding the behavior of interest rates, their economic drivers, and the structure of financial markets enables organizations to manage financing costs effectively, evaluate investment opportunities accurately, and implement comprehensive financial risk management strategies that support long-term organizational value creation.